Everybody, welcome and thank you for joining us for our live stream with a special guest, Brent Johnson. Yes, we're really excited to have this one back. It's a very timeless one. We've been wanting to have Brent back for a while, but a number of key technical shoes have started dropping. And you know us, we love the macro technical. This man has had the eyes on what would and potentially could and should be happening from the first time I spoke to him. It made absolute counterintuitive sense in terms of the Brent Johnson theory, known as the dollar milkshake theory. On that point, a lot of mischaracterization have occurred in terms of what people understand by the dollar milkshake theory. And it is not just only about the dollar. We'll be giving Brent a chance very early on to clarify that for all of you just checking in. What I'd ask you to do right now, hit the like button. It helps us, gets us going on the algo. It's puppy licks to the face. We love that. A share is true currency for us. We're doing this for free. It's great technical effort. We're bringing smart people to talk about fascinating concepts at key technical macro trading points as we go into what could be the beginning of real reset FX moves. Without further ado, I'm going to introduce to you Brent Johnson. Brent is the Chief Executive Officer and Portfolio Manager at Santiago Capital. A lengthy and remarkable career at Credit Suisse. He is a hedge fund manager. He's focused not just on the dollar, but bullion and million other aspects of the core macro markets. Brent, thank you very much for coming back. We're delighted to have you. How are you doing?
I'm good. From one island to another, if I'm not mistaken.
That's right. You have moved recently. Tell us a little bit about that before we get into the serious stuff.
Yeah, so I was in San Francisco for 20 years, and I always really liked San Francisco, and I still love San Francisco. But it was kind of I'd been there for 20 years. I'd been kind of itching to do something a little different, and the timing with working from home due to the pandemic, and just a couple other things happening within my family and life, it just kind of made sense. And so we moved to Puerto Rico about 6 months ago, and it's just been a fantastic move for us.
Oh, that's great. That's great. Lovely. Many happy years of sunny bliss and hopefully not too much tax extraction as well. Brent, let's kick off straight from the beginning. Lots of people think they know what the dollar milkshake theory is. Many people don't and would love clarification.
Yeah.
It's not just about the dollar, is it? Let's give you the opening gambit to really lay it on there. What is the dollar milkshake theory?
Well, the dollar milkshake theory is really, really, in many ways, misunderstood. And what I mean by that is I think there's this misconception that I'm out there just sitting in dollars waiting for this spectacular crash. And that's not the case at all. I actually, the dollar milkshake is really a framework for how I see a global sovereign debt and currency crisis playing out. And I actually started talking about this framework back in 2018 and 2019. And, there's been many people who have said that the dollar milkshake has been proven wrong. And I'll hold up my hand and say that I got the timing wrong as far as how quickly a currency crisis and debt crisis would happen. I thought it would have happened by now. It hasn't. But until we get into that, if we get into a sovereign debt and a sovereign currency crisis and the dollar falls and everything else that I've said that turns out to be wrong, then I'll hold up my hand and say I got that wrong. But we really haven't gotten there yet. And so I just happen to think that a rapidly rising dollar, well, if the dollar gets to a certain level or higher, or if it moves too fast in an upward direction, bad things happen to numerous different financial instruments around the world. And this has been proven time and time again, 1987, 92, 98, 99, 2008, 2014. 2018 and 2020. A rising dollar and high levels of volatility and financial crisis just kind of go hand in hand. And so I believe that due to all the debt in the world and due to all the problems in the euro dollar market, that debt will eventually matter. It doesn't matter right now. It doesn't matter. Everybody's just gambling, for lack of a better word. And that they're not worried about the fiscal problems or the debt levels and et cetera, et cetera. But I think at some point they will. And when that happens, I think that's when the dollar milkshake theory kicks off. But I'll wrap it up here. But the dollar milkshake theory is not just sitting in dollars. In 2018, 2019, I started saying that equities were going to go higher because the dollar was going to go higher. I said gold was going to go higher because the dollar was going to go higher. I said treasuries were going to continue to be bought because we were the sovereign, we were the global reserve currency, and our bonds are denominated in the global reserve currency. I haven't called it perfect, but I don't think any of that stuff is dramatically wrong at this point, right? Now, the dollar certainly but when I started talking about this, the dollar was in the high 80s or low 90s. Now, it had a run up to 100 a year and a half ago, and it subsequently went back to the high 80s. But now we're back into the middle of the 90s and mid 90s. And the reality is the dollar's pretty much gone sideways for 10 years. I mean, if you look at a long-term chart, I think the dollar's been between 85 and 95 for 10 years now. Something like that. And so, or at least 5 years. And so, we're just kind of biding time until, this currency crisis comes. And if it never comes, I'll be fine. My clients will be fine. We still own a number of risk assets. We think that, there's certain ones you should own and certain ones that you shouldn't, but we're not just sitting in cash waiting for the sky to fall. We don't think that's the right way to play it. We just think you have to be ready for the sky to fall. And I don't have the tools to time it perfectly when that is. So we have hedges in place that should pay off very well if and when this currency crisis develops.
Can I jump in there, Brent?
Sure.
Very good opening gambit. But one of the reasons we're excited to have you back is, it's contraintuitive, and these are often the best answers. It's the minority view by a long, long way. That actually financial resets. So our interest is the macro technical and wondering what order the shoes drop in a financial reset. So we have a lot of overlap of interest. We're just approaching it in different ways. And when I first heard you making the case that actually failure could come on dollar strength rather than dollar weakness against this wall of view that, as I mentioned, someone like Peter Schiff, so many others that are wanting to be gold and precious metal bulls all see that first as being an immediate dollar failure. They can't see, for example, that there could be a surge in strength first as part of one of the process of all the dominoes falling over before subsequent possible failure. And I thought that you were very innovative, and it made absolute sense when you consider the concepts of Triffin's dilemma, the need for perpetual exporting of dollars, the over-indebtedness of other nations, such as ones we discussed like Turkey, which we'll take a look at the chart on in a wee bit. But I thought I'd just bring you back to the charts. You were referencing it, and you said, for example, you were in and around the 80s. Yeah, okay, yeah, sure. Just making sure we're keeping you in the shot here. When you started talking about it conceptually, I think you must have been around 2018. Those were the 80, roughly the 80 levels.
That's right.
You had the benefit of a bit of dollar strength. We had the super skittish pumpermentals, then subsequent dumpermentals that went with the pandemic event that led to all that epic level of printing that brought the dollar right down again to the upper 80s, sort of 88 range. And now we're in this point over here. When we spoke, we always felt that there was first a dip to come. We thought conceptually, ideas-wise, you were the right idea man, just maybe tad early on the timing. The key aspect that's super interesting for us technically is that if we look at this pink box that we've got over here, you mentioned it, the decade almost of period where you've been largely in the 88-100 zone, that actually technically the narrative starts to spend that the timing for when you may get an outlier move in dollar strength is coming closer and closer. We get a technical squeeze, and we see over here 111, and then potential, if it were to allow it to go so much further, 120 even being possible on a hard ceiling technically. And we just obviously had the 7 trillion odd that was printed. That's invariably going to be devastating initially for the dollar as it makes its way out. But what we wanted to highlight, almost like the cavalry in some sense is coming for your thesis technically. And I don't know how much you followed macro technically, so you may already be on top of all of this. I just needed to maybe give you some of the backdrop on it. But that we're actually, the dollar has been in a huge falling wedge if you go in a monthly time frame. So I'm going to just jump out. Sorry, that's oil chart. I'm going to get the same index up over there and jump him on, and then go right the way up to what's been happening since, as far as I have data.
I saw you posted that. Well, you've posted it several times, but I've seen it before, and I love this chart.
Yeah. Let's go to the smaller time frame. I may battle to find the one I have in mind. It just doesn't, the one I have in mind has huge amount of history. It's a monthly chart, massive falling wedge all the way from the 80s for the dollar. That then I'll conceptualize it, even though we don't have the full version, I'll tweet it out, that we actually broke out of here in essence. And that this structure, if I draw a line, if you have real lengthy history, and I'm a bit frustrated that that particular version isn't there, but you have this huge multi-decade falling wedge, and actually we've broken out of that. That was the 2015 run up to the 2000 and sort of 2014 to mid.
It started in the summer of 2014, and I have to, you know what, this is a good. I'm going to take 10 seconds right here, and I'm going to say a big thank you to my friend Raul, because at the time I was the dollar bear, and Raul told me no, the dollar's going to rally, and I said you're crazy. And over the next 6 months, the dollar went on a huge run, and that's when I sat down and I said, okay, well, what have I missed? What am I not understanding here? And that was kind of the genesis of the whole theory, to be honest.
Yes. And I think it seeded something incredibly interesting. And the chart that we've been putting a slightly lower time frame, it's still macro though, is the weekly. And we'll have a look at it on the Euro USD, because we're going to have to talk about the Euro in all of this. And I know you'll have some interesting thoughts. Is this double-headed, inverted head and shoulder? And this was, of course, a massive triggering event here that took place. Yeah. I had the 94.5 as a neckline. And just for those that maybe aren't seeing this so clearly, maybe I should do 3 days instead of a week. That's a bit granular for the people watching. But you've had a huge reversal from a 7 trillion plus print. I don't know if you know the exact number anymore, but I don't know if it matters.
Like that.
It's absolutely epic.
It doesn't matter. It's not enough.
It's not enough, and it will need to be more. And I can see more of it coming. And here is that triggering event for that, which on its own, just as this reversal on the weekly time frame implies a 99 odd value. We're probably going to take a little rest. So now that we've chased in to discuss this, you can see a little bit of an engulfing sort of shooting star occurring. So for those watching right now, looking for a trade, this is not a call out right now for the trade. It is more about the macro trend. You need to let a pullback take place. You need to find that low. But overall, as a risk reward, this is one we've given out that will look exceedingly well. Why? In terms of Triffin's dilemma and the need to export, what's your own take on this? And also you mentioned the one thing where I might diverge a little bit is you mentioned initially you were long corporate government debt treasuries and felt that the chasing of the dollar would automatically see a lot of money flow into treasuries. We know debt is the problem. We know debt is the risk. We are actually calling turns on a 40-year bull market in bonds. Why do you think the debt markets will be supported? Can it not come into dollars to chase ever expensive equities, even higher? On the basis that at least they give yield, real yield in many instances. The bonds are negative yielding. They're incredibly fully priced. And the long term is there's a transition into a potential new financial system. We might get a higher bleed out into Bitcoin and crypto, a higher bleed out into gold. We've just seen gold and silver go up on a strengthening dollar, something you mentioned as well, which is a mini flippening event. You needed to do it obviously on a sustained basis for us to say it's the reset run. But just give me your take on debt markets and the dollar, because there's
but there's a couple key variables that I think it's important for everybody to consider. And the first thing you need to understand when you're looking at this, especially if you're trading it, is what currency are you based in? Now, what I mean by that is you could have huge falls in one currency and a huge rise if you're denominated in another currency. So and not only that, but my call, it has stages in it. So I think at this point, there will be one last rush into U.S. Treasuries. I think it's likely, not guaranteed, but I think it's likely that rates go lower again. We have one last test, or whatever you want to call it.
This
and
is
then it becomes a relative game.
This is the iShares 20-year Treasury bond, by the way, that I'm showing at the same time, Brent. And again, we've got a bit of a head and shoulders possibility in there. It doesn't mean it has to happen just because you have 3 bumps in the road with the middle one biggest. But there is that head and shoulders possibility, which we're modeling. I'll take you to the yield on the 10-year as well. We like to show the monthly chart. So I'll give this as a map for you to refer to as well while you're talking on debt. Sorry to interrupt. Carry on.
No problem. If you look at that chart, it's just a long-term trend lower, right? And listen, I cannot rule out I eventually think that we are going to break that to the upside in yields. And when that happens, I think it will not just happen to U.S. Treasuries. I think it will happen to sovereign bonds in general.
All over.
And at that point, I think it becomes a relative game. I don't think we are going to have people selling bonds due to credit concerns on a U.S. Treasury while they are still buying Greek Treasuries or Australian Treasuries or Canadian Treasuries. So
it's going to be an
asset
category based fear global, is what you're saying.
That's right.
Yeah,
that's right. So when money comes rushing out of sovereign bonds, I think in general some of it might go rushing from other sovereigns into U.S. sovereigns. But even when it starts leaving U.S. sovereigns, I think that the outlet is going to be U.S. equities. And I think that as yields rise, it's going to suck dollars in back to the United States because you get paid more to be in a U.S. Treasury. Yeah. Right. But as it flows into the dollar, then it won't just stay into treasuries. It will probably go into U.S. equities. Right. Yeah. And so I still think that as the dollar rises and as the global currency crisis, as people flee sovereign currencies and as they flee sovereign bonds and as they flee emerging markets, I think, and as their currencies fall relative to the dollar, they will want to hold dollars. Yes. Then I don't think they will just hold dollars. I think they will hold equities. And I think equities, despite the run that they've had, and despite the fact that I think we are probably overdue for a pullback, I ultimately think equities are going much, much higher. And this is the crowding out theory. Almost, right. Brent. Sorry, Brent, to cut in. It becomes... no, go ahead. No, I was just saying it's almost like it's the stepping stones that start to sink. And the firing order is first we get the dollar strength. That will drive, say, euro debt into dollar debt, denominated debt, which will also see some of it rather go into equities initially. Some will jump the dollar debt. That's right. Some will go straight into Bitcoin and gold and silver. But then as it starts to ebb out of dollar debt, it will stay domestically in American equities because the money will chase the liquidity, the scale, and also the momentum, which will continue to be equities. And we end up in this massive FOMO of super overvaluated. That's exactly right. Yeah, I think you get it. And here's the other thing, and I touched on this a minute ago, and I think this is important to understand. I'm just going to throw out a country. Let's pretend you're from Chile, just as an example, right? Yeah. Or you're from Brazil. Let's just use Brazil. And let's pretend that the U.S. Treasury drops in price by 15%. Okay. Well, if the Brazilian real drops versus the dollar by 20%, and you're a Brazilian and you own a U.S. Treasury, you've still made 5%. Correct. So, and this is my point. You need to understand what currency you're denominated in and what it is you're trying to accomplish. And again, I know many people disagree with me. Many people think that when we get into the next crisis, people are going to flee the U.S. because it's the empire that's going to fall. And I say that will happen, but not yet. There will be a progression. Correct. And it will start at the periphery, and people will flee Turkey. They will flee Egypt. They will flee South Africa. They will flee Brazil. They will flee Australia. They will flee Canada. They will flee Great Britain at different times. But I think they will flee the United States last. And as that progression happens, if you think of, let's say, pretend there's liquidity in a system. And as you squeeze those other systems and the liquidity leaves those other areas, it gets squeezed into the United States and the dollar. And it pushes those asset prices to where it's getting squeezed higher. And once the squeeze is over, it will collapse and the liquid will rush the other way. But so far, I think that the liquid is going to get squeezed up into the U.S. and into the U.S. dollar. Once that big, eruption is over, it will go the other way. But I think that is still a few years away. I don't think that's next month.
Absolutely. In fact, talking about squeezing the liquidity ever higher and into something we discussed 14 months ago when we first worked together was in fact the Turkey debt situation. And I brought up the USD try at the moment. That made our target over here, which was, this is our HVF setup for those watching, and we called a target there. After that target, we got a sustained falling wedge pullback period, which was inevitably going to be temporary. And we've got an absolute parabolic melt up in process at the moment, Brent, which once again validates our theory about what was going to happen. And it brings us back to that sort of the village of currencies and how you will fail from the peasants that are outside the city walls first into the ever tightening walls where the king is in the behind three walls in the center, which would be the dollar. And we were already seeing in slow motion. I keep saying people always ask, when is reset? When is reset? You're the reset guy and you're watching it. And I have to say it's already in motion. Look at this chart to see it already in motion. What's your take? And
I think Turkey is a good model for everybody else. It's taken a while to play out, but now it's happening. And I remember people were telling me this isn't going to happen, but here it is. And I have to say, I'm a little frustrated with Turkey because we've had the trade on for a while, over a year and a half, almost 2 years. And it's just now starting to play out. We have it in both direct form and options. And so we've had bleed on the options. Obviously, there's decay there. The other thing, this will be interesting too. I don't know if you can do this. So anyway, we're making money on our currency short, but we're also short Turkish equities.
Yeah.
I don't know if you're able to pull up Turkish equities.
Sure.
But if you could pull up a chart of Turkish equities.
What is their biggest index called?
It's called. Give me 1 second, I'll tell you. I always forget. I always have to look it up. But if you give me a second, it's called the BIST 100 index.
BIST 100. Pity, it seems your Bloomberg screen is outdoing me. I don't have it.
Okay. Well, I'll tell you. I'll just let me tell you why it's frustrating. Because if you look at it in lira terms, it's done really well.
Hold on, I found a BIST 30. Hold on, we've got a BIST 30.
That'll work. That will work.
Yeah, it's a continuous contract on the future. Let me just take us out there and have a look at it.
Yep.
We can, of course, on this platform divide it by the lira as well to show its relative underperformance compared to the currency devaluation. It seems actually
that's the point I want to make. If you look at it in dollar terms, it has started to break down. In lira terms, it's still rising, but in dollar terms, it's starting to break down. And if you go back to when we started shorting it a year or so ago, we're just now kind of below. It's just now starting to pay off. It hasn't really paid off yet, but it's starting to. And so, but this is a case where, I think a lot of people, everybody has to figure out what their trading style is. I am not a short-term trader. This thesis is not based on technicals. I look at technicals, and technicals kind of favor us right now. But if I was purely a technical trader, I would have sold all of our dollar positions or our dollar hedges, at like 94 or 95 last summer, when it broke through that support level. We have a diversified portfolio. We own fixed income. We own equities. We own gold. Clients own real estate. We have private equity funds, venture capital funds, Bitcoin. Clients have diversified portfolios. Because we don't feel like we can time it perfectly, what we have said is, because this is a fundamental call on the rise of the dollar, is we have allocated between 5 and 10% of a client's portfolio, depending on who they are, to some of these asymmetric trades that will not just have a small payoff, but a huge payoff if and when this global debt crisis actually plays out. And as a result, that 5 or 10% will hedge the other 90 to 95%. But I'm not somebody who thinks that you should be all in on, global markets blowing up and just be short everything in the world. I think that's very dangerous to do that unless you have a very, very good timing tool. And I just don't have that timing tool.
In fact, it's the big long, as far as I'm concerned. If you want to be long equities, everyone calling for a crash, unfortunately, they have a valuation-based concept instead of a liquidity-based concept. Where's all this liquidity going to hide? It's going to hide in crypto, it's going to hide in gold and silver, and it's going to hide in equities that generate a better yield than negative yielding debt. I can't see too many other places.
Yeah. That's the other thing that a lot of people get wrong about the milkshake theory and the thesis. A lot of people think because I'm a dollar bull that I'm a deflationist, because typically when the dollar goes higher, you get falling asset prices. And I do think that that's probably likely initially, but the response from central banks will be to provide more stimulus. And if you think about it, what I'm saying is, yes, the US is going to print. Yes, the US is going to provide stimulus. But as it rises versus other currencies, they're going to have to print even more. They're going to have to do even more stimulus. And as that happens, their currencies fall versus the dollar. And so if equities start to rise and gold starts to rise and Bitcoin starts to rise, even versus the dollar, then it's really falling a lot versus foreign currencies. And as they have to print more, it becomes even more inflationary. The problem is the rest of the world also funds itself in dollars. So they're going to be losing purchasing power in the currency that they print, but they're going to be getting deflationary pressures from a rising dollar in which they get funding. It's the worst of all worlds. And because they're in the worst of all worlds, I think capital will flee those areas and go to the United States, where it is treated on a relative basis, maybe not perfectly, but on a relative basis better. And so, and as that happens, asset prices rise. So ultimately, the dollar milkshake theory is an inflationary thesis. I just think it's going to be punctuated from time to time with absolutely jaw-dropping deflationary impulses.
Yes.
If that makes sense.
No, it absolutely does. In short, we're going to continue. We're going to continue to get liquidating type sell-offs in our inflationary thesis, because a trade is never a straight line up. And I absolutely agree with that. I'm going to just bring in a question, because we've got both the YouTube live stream and my private community here that are in. So I've got a community question from Tito. How does Brent view the Eurozone and connected economies, especially Poland, so this potentially a Polish community member, in the moment of the extreme blow-off, say dollar index running 99, as I've got a target for on that inverted head and shoulders, then the larger triangle continuation, we call it an HVF, running up to 111, maybe beyond 15, 20, possibly. Not saying those are all forecasts or predictions. That transition to that, how do you see it? Which brings me to the euro, the Dixie. Obviously, a large part of that is the euro. It'll have the pound and the Swiss franc a little bit in there, and a little bit of yen. But what sounds good for, I always try to explain simplistically to, and I don't know if you'd concur with us, Brent, in answering this question, but what's good for the dollar tends to be bad for the euro. It's almost like they're a seesaw triangle. Big treasuries will sit with lots of both currencies. And if they have the perception that one is going to be doing something beneficial for the currency, you will see the biggest downside will be for the other most held currency. So if we start to get a dollar inflationary viewpoint, a possibility of rate rises, bit of taper tantrum, a little bit of the early sparks of the milkshake fire, we're going to actually see straight away. And this would take us to our second trade that we really love, which is a short on the euro against the Swiss franc. So we short the euro USD on a head and shoulders, which is basically the opposite of the inverted head and shoulders of the Dixie. I'll bring the chart up in a minute while you're answering. But what's your take for Europe? And are there any fundamental triggers in that you would like to add why Europe will be in trouble?
Yeah, so there's a couple. Now, the first thing you have to understand is it's not only the Fed that has lost its mind. All of these countries have done it. You know, one of my favorite moments of all of the last 13 years is when Mario Draghi stood up there and he said, those who are predicting those who are predicting the demise of the European project don't know what they're talking about. The political capital that has been spent will continue to be spent, and we will spend whatever is needed, whatever it takes. And then he said, not only everybody remembers whatever it takes, but he put something behind it. And he said, and believe me, it will be enough. And you know what? He was right. For 10 years, almost 10 years now, he's been right. But my point is it's not only the U.S. who's been printing and spending and doing the bailouts. And it's not only the United States who is feeling the inflationary pressures. Europe is feeling extremely high inflationary pressures in both food,
particularly
and
energy,
natural gas, and energy.
Yeah.
And what did Lagarde come out and say yesterday? Did she come out and say we're really concerned? We feel bad about your cost of living rising? No, she came out and said it would be hazardous for us to try to combat inflation. Now we could throw ourselves back into a recession. So my point is
that sounds like benign neglect, doesn't it?
Yeah, this is not a uniquely American phenomenon. Now I get it that it's very easy to throw stones at Powell and Yellen. I mean, we've got a bunch of clowns running, things here. I'm not going to deny that, but it's not like you leave the United States and all of a sudden the politicians become these very altruistic, smart, and humanistic beings. They're the same everywhere, and they're all doing the same thing. They all went to the same schools, and they all have the same programs. And the problem is those countries and all those other areas that are doing the same thing do not have the same demand for their currencies on an external basis. The whole world needs dollars. The whole world needs dollars. The whole world does not need Brazilian reals. The whole world does not need euros. The whole world does not need yen or yuan or lira or whatever it is. So if everybody prints, then it comes down to a demand issue. And there is just quite simply more demand for dollars than any other currency. So now as that relates to Poland, I'm not going to sit here and pretend to be an expert on Poland. What is their currency? The zloty? I think it's the
Polish zloty, the PLN. I'll get it up for you. Yeah, that's the right. Euro. I'll just get the zloty up for you as well.
But I think in general, I think they're lucky that they're not part of the euro. I think it would probably be tough. I think initially, if there's some kind of a breakup of the euro or the European Union, it may be hard on Poland initially, kind of like UK is kind of having a little bit of a tough time in the short term. But I think long term, I would rather be outside of the euro than inside, because I think whoever leaves the euro first leaves it best, because I think the euro is going to break up.
Yes, and that sounds like a comment that probably will tie to our UK audience as well. So you might have killed a couple of birds with one stone there, Brent, in that just not being in the euro is a minor form of blessing. But that doesn't mean you're going to get let off the hook. The pound is going to just be somewhere in between the dollar's strength and the euro's complete capitulation.
Yeah. I mean, the other thing I'd say is, a lot of times people will say, Brent, the whole world is sick and tired of the United States. They've been a bully forever. They've imposed their way. They're not nice about it. They've been the biggest cause of all the conflict. They haven't been the shining light that everybody looks to. And listen, I don't actually disagree with that. I actually agree with that to a great deal. But if you're going to say that the United States is the bully on the playground, you have to understand the way that the bully on the playground becomes the bully on the playground is that he typically wins all the fights. Yeah. He doesn't always win, but he typically does, right?
When you want protection, you run to the bully. That's
exactly.
Again, not the maths geek.
Right. I mean, I don't like this, but I'm not investing for what I like. I'm trying to make money, right? Yeah. And so at the end of the day, I think that the U.S. will continue to impose its will. And despite all its imperfections, despite all the negative assertions you may ascribe to it, it's still the biggest kid on the block. Yeah. The game is still rigged in their favor. They still have innumerable assets that they can use to fight off whatever's coming. And I think as that happens, it's going to be the schoolyard bully running around beating everybody else up. Now, eventually, he's going to fall. I'm not going to deny that, but I just think he's not the first one to fall. The bully isn't the first one to fall.
No, he's one of the last, yeah. And I think this will take us to central bank digital tokens that I want to take you into a little later. But before I do that, just on a similar note, you could take the Danish kroner also lots of debt, a lot of the socialist issues of the euro, and you've got exactly the same setup as we're looking at on the dollar index, basically the USD DKK. And we have very similar targets. If you're a Dane, 7.7, you could have had this trade in at 6.3. In FX terms, that's a massive, massive pip related move. We're getting the same structure. As small guys, you're not going to escape the big tornado. The big tornado is going to crush your little house along with all the other little houses. You haven't got the concrete bunker, which is essentially what Brent is saying, the United States.
Let me make another point, and we'll use Turkey, since we already talked about Turkey, we'll use Turkey as an example. The other thing that I think a lot of people either don't understand, or the ones who do understand even then sometimes get wrong, is the euro dollar system and the euro dollar debt.
Yes.
I'll often explain that the rest of the world owes just as much in US dollars as the United States owes in US dollars. And the response that I will get, well, yes, but the rest of the world will just default on those dollars and move to a new system. Okay. So here's what I think a lot of people forget on this. One, they would all have to do it at the same time and figure out what the new unit of account, who's going to enforce it, and they're all going to have to agree to do it on the exact same day. Now, let's pretend that they do that. The other thing that they forget is when they default on those loans, they're not defaulting on the United States. Euro dollar loans are not loans made by the United States. Euro dollar loans are loans made by international entities to other international entities. And Turkey's a good example of this. Turkey has a lot of US dollar debt, but a lot of that has not been loaned to them by the United States. It's been loaned to them by Spanish banks and French banks and Italian banks and Greek banks. And so it's the European financial system that has exposure to US Turkish debt, Turkish US dollar debt.
Such an important point that. Can I stop you and let you get flow back? Such an important point. We see euro weakness on Turkish lira weakness. And what you've just said has reminded everybody why that absolutely could be. We're seeing it in the charts. So we're seeing the euro weakness. We're seeing potentially financial system. We'll need to look at it. Which was the bank, actually? There was a Spanish bank, particularly by name. Are you familiar with it, Brent?
You know, I'm not sure which individual bank it is.
There was one that we were watching when we were looking at the IBEX as a potential short, and it was one of the biggest. It wasn't it might have been Santander, but there was another one as well, Bank of Bolivia with a B. Anyway, that's absolutely very valid. I just wanted to put a double underline on that.
I can use another example that will perhaps help some of your European watchers understand it even better. Is about 10 years ago, a large number of, I think, Hungarian, Czech Republic, kind of in Eastern Europe, had taken out mortgages from Credit Suisse and UBS denominated in Swiss francs. And then when the Swiss francs started to strengthen against those Eastern European currencies, they had a crisis. Eventually, I think the European Union had to kind of step in and help with that, because if you're borrowed in one currency, but you're denominated in another. And then when those loans go bad, it doesn't, it wasn't necessarily hurting Hungary and the Czech Republic. It was, but it was flowing back to those banks that had lent the money as well. So it's when you denominate your debt in a currency that you can't print, and then your currency falls, you are in really bad shape. Yeah. And the whole world, due to the euro dollar system, is in this potential problem.
Yeah. Yeah. What's your take? It was Banco Bilbao, is one of the guys in the comments. Vizcaya Argentaria, that might have been one of them. I'm just checking in with the YouTube. That was possibly the Spanish. It might be the reason why I couldn't remember it as well by name. So, Brent, central bank digital tokens. We know that they're brewing something. Yes. We know that the new system is ponying up. We know that after that, the dollar might then lose its hegemony post this event. Yep. But that we first have to have everyone crying out for a new system, being killed by this over-dominant dollar as all these flaky peripheral emerging currencies continue, because many of them have already started. If you look at the Rial and the Indian Rupee and the Pakistani, I mean, the minute we look at those countries and Argentina, I mean, they've actually begun reset long ago. But as it starts to come, I mean, Turkey's a pretty serious on the doorstep of Europe, 80 million population, quite a massive economy, to be frank. It's quite a big one to start becoming a problem. South Africa could be one of the ones that get lined up next. Who knows? But as we start getting behind the city walls and into all of them, and we get the diametric position of the Europeans crashing on the dollar strength, we actually are being attacked on two fronts, from the periphery through the FX emergings, and then the second biggest currency of the world, as strong as the dollar becomes, almost gets leaned on by the sort of
when that starts happening, then you're going to start to get contagion. Like so far we've had little blow-ups here or there, but the locals have been able to contain it. So far, Erdogan's been able to contain it to within Turkey. So far, in Argentina, they've kind of been able to keep it within Argentina. So far, the problems in Hong Kong and China, they've been able to kind of keep them within Hong Kong and China. It hasn't spread. But again, as we get further into this, you're going to start to have contagion effects. And I wish I knew which domino fell first, and I wish I knew the exact progression. I don't. I have a high degree of certainty. Again, I'm not certain about anything. That's the other thing. I just take a real quick aside. I speak to so many people in the last 6 months who think that they've just got this totally figured out. And I'm the first to say that I might be wrong. I'm not certain about anything. I have strong beliefs, but I'm not certain about anything. And so, I think there's a lot of people who think that they're just absolutely certain that the governments and the monetary authorities have this all under control. And I just don't think they do. And when one domino falls, it's going to start leading to contagion in another one. And I don't know exactly which one it is. But, you can't have, we think the euro is going to ultimately go into the 80s. I mean, it's at 112 today, 113? It could easily go to parity. And then after that, we think, again, this isn't tomorrow. This might take 2 or 3 years to play out, but ultimately that's where we think it goes. You can't have the euro go from 115 to 85 and not have some contagion. It doesn't work that way.
It's falling kind of quick, Brent. I would say I think you could get sub 110 in months, even possibly weeks. The parity level is very psychological, and it seems there's always been a support in and around the 105s for long term. But if I put it the other way around, the USD first as the base currency, I can see parity up here, and this technical structure, which once again looks very much like the dollar index, the picture doesn't change.
It's the same chart.
It's the same chart, right? The geometry projected from here at any reasonable level sees a parity run and sees 108.
Well, not only that. Okay, pull up the yen. Pull up the yen.
Yeah. I'm glad you brought up the yen, because I want to take you into the Eastern realm as well, because we've made a host of dollar-based strength calls, and we've included the Eastern currencies in this. It's not just a euro failure story. It's actually a dollar strength story from across FX emergings, across Europe, the Eurozone, particularly with the euro, but it's also a yen. We've got a 136 call on the yen. Is that a decent enough time frame monthly?
Yeah, that's fine. But the point I wanted to make is, it started to rise. So it hit its lowest point in a long time at the beginning of the year.
103.
I think at 103, right? I think at one point a year or so ago, it might have been at that level, but it's kind of at the lowest point it's been in a long time, and now it started its rise. Yep. And even if you go, if you look at that, it's starting to break out. Once you get above 120, if you really pull back a 30-year chart on the yen. Once you go above 120, which is not that far away now, there is no resistance anywhere.
Yeah, it's been above the 120 and above even the 125. Yeah. When we stabbed above it up top here, we did have a head and shoulder, and that was a big reversal. Yeah. But that was a technical run of a real legacy rally. When you were still on the long term, you were on a bear market for USD JPY. It largely came like that. Yeah. You had a rally, and this was final lows. Then we had the Kuroda print.
You see the reverse head and shoulders here?
At what we're actually seeing a continuation pattern of this bull market. This is how we're technically calling it, Brent. I'll draw it again for you. I think probably need to be on the weekly just to capture this. We think that was a turning point for the lows of yen down here. And we think we started a new bull trend essentially for reset here. That is that.
You mean for the dollar versus the yen, or
for the
yen
USD yen? Yeah, for the USD yen. We may be wrong, like any.
There's like a 30-year head and shoulders. There's like a 30-year reverse head and shoulders as well. But I guess my point is this is not due to one problem in China. It's not due to one problem in Europe. It's not due to one problem in South America. Everybody essentially has the same problem. It's just that the U.S. happens to have many advantages that the rest of the world doesn't. It's not because we're smarter. It's not because we're better. It's not because we managed our money better. We just happen to have a number of advantages that the typical market leader has, right? And I think that we will use those to our advantage. Now, ultimately, it will fail, but this is people have heard me use the Kurgan analogy before. Like, it's really, really hard to kill a global reserve currency. It's not impossible, right? It's just really, really hard. And when you get into a currency war, I use that analogy, there can be only one. Yeah. And when you get into a global debt crisis and currency crisis, I just think the dollar is going to ride around the world cutting heads off. And I know that sounds dramatic and it's kind of silly, but I think it's the best analogy I can come up with to just kind of explain, like, nobody's really safe. Like, this is just not going to end well. And if you have any doubts at all, just go back to last March 2020. The dollar only went to 102, and the whole world went to its knees.
Yeah.
Right? Imagine what if it goes to 110 or 115 or 120, it's not going to be pretty. And the other thing I should point out is I get a lot of people who say, yes, Brent, but all fiat currencies are being debased. All currency is losing its value. So why does it matter if the dollar is just the best of the bad bunch? And the reason it's bad is because the whole world owes dollars. The whole world is leveraged off of dollars. And when you get into a short squeeze and your assets start to fall due to leverage, everything gets sold that can. Not that you don't get to sell what you want to. You have to sell what is sellable or whatever is liquid. Yeah. And the margin controllers make the decision. You don't even get to make the decision anymore. And that was very evident a year ago. It was evident in 1999 and 2000. It was evident in 2008. It was evident in 2018, and it was evident in 2020. I mean, I just don't. If you think it's different this time, and you're willing to bet it all on it being different, then God bless you. But I don't know what more proof I need to show than the last 4 times this is how it's worked out.
Yeah. Can I take you into 2 other currencies before we refer to a question from the YouTube? Number one, what do you know about Korea that I feel so probability orientated for a better part of a 45% plus collapse? What would be interesting about your Korea? And then I'm going to take you to one that you know very well, which is probably your favorite that I expect you still have the trades on, which is the Hong Kong dollar, which almost seems superfluous nowadays in this modern world, which has this wild card on the Chinese USD CNY CNH. So first, the Korean one. Why would Korea? Is it just all part of the dollar thing, or is there any specifics and fundamentally that you would associate with it?
There's nothing specific. Well, there's a couple things that are specific. One that really helps them, and one that really hurts them. And the one that really helps them is that they, the movie Dune just came out again recently, right? Or the remake, and it's very popular. And the spice must flow. And it's often been, oil has often been attributed to being the spice in the United States or in the global economy. But the other spice that must flow is silicon and chips, right? And most of the world's chips are made in Korea and Taiwan. Taiwan mainly, but then also in some in Korea, and they have big tech sectors. But the location next to China. Yeah. Which China has global ambitions, and this is just this is geography. Yeah. This even has nothing to do with finance, but they are penned in by a number of island nations. They're penned in by Japan, and they're penned in by Korea, which is a peninsula, but then they're penned in by Taiwan and the Spratlys. And at some point, China, if they want to become a global hegemon, they need to have direct access to the sea, and right now they don't. And so you've got Korea, Taiwan, Japan, and all, it's a global hotspot right now. And if there is some kind of military action, the dollar is going to go through the roof. And that's just going to be bad for those currencies.
So geopolitical rather than financial, you would guess.
Yes, geopolitical rather than financial. But again, all of these countries, everybody trades in dollars. Again, it's nothing that necessarily any one country has done wrong. The whole thesis is based on the system itself. Yeah. It's not based on this president or that financial minister or that CFO. It's the design of the system itself is coming under attack.
Yeah.
And as the design of the system collapses, the dollar falling is not the system collapsing. The dollar falling allows the system to perpetuate.
Yes.
It allows you to borrow more dollars.
Makes sense.
It allows the system to continue. It allows the system to continue running. So if you think the system is collapsing, it's going to collapse from the dollar spiking, not the other way around.
Yeah, and that point is well made, and I agree with it. I totally concur with it. I just wondered if there was something else. I thought of geopolitics, the South Sea Islands and all of that. I thought of the high-tech literacy and maybe any sign of weakness or run into Bitcoin and more crypto orientation in that area, because they're very switched on technologically. They're young, they're smart. That could also see a massive leakage out of their local currency, also quite easy to do for them. So it could exacerbate. I'm trying to find which are the best trades on reset. We all agree this is about dollar dominance, not necessarily about individual nation weaknesses, although we have the likes of Turkey and South Africa that have done plenty to help the cause of destroying their own currency. I was just interested, is there anything in that category for them? You do have a comment on Hong Kong.
I don't make individual stock projections, and I don't bet on individual stocks, so I don't have any individual names. But what I will say is I think there's a lot of people who have looked at the NASDAQ recently and just said this is completely nuts. Or they look at Kathy Woods and they say she's completely lost her mind. I actually don't think that Kathy Woods has completely lost her mind. Now, this is probably going to sound kind of crazy as well, make me sound like I've lost my mind. Now, I think she may be over her skis a little bit, but I think it's very possible we get a correction. But I think 2 or 3 years from now, technology is much higher than it is today.
I agree with her and Raul on the exponential age thing in the tech. We're cutting new territory, life extension, all of these things. People are going to pay millions for this sort of stuff. It's growing hugely, computing power. Yeah. We're in the exponential age. Yeah. That's why I think short callers on the NASDAQ will get beaten. They'll be disappointed. It'll come late. It'll be smaller than they think. And in a year's time.
Maybe in the short to medium term, there's a pullback in the NASDAQ, but I wouldn't want to be short for the next 2 or 3 years. And to the extent that there's high-tech companies in Korea, Taiwan, that kind of the Asian nations, I would be a buyer of those types of assets. But the area that I am probably most bullish on, but I am probably most underweight relative to where I want to be, is agriculture.
Yeah.
I think that is going to be an area that I just think does amazingly well. Now I've been being very patient, because I own some. I want to own more, and I might just have to chase it. I'm trying not. I always say, if you're just patient, you'll eventually get your chance, right? It might take a while, but you'll eventually get a pullback. But I got to tell you, I think agriculture over the next 2 or 3 years is going to be the place to be.
Well, it's the Jim Rogers trade, as he said. It'll be the farmers that drive Lamborghinis, and he again was early, but not wrong in my view. We're starting to see that. They're trying to sell us that it's all climate change, that coffee prices have gone up, because of fire here and a fire there. There's fires every damn year. It's totally inflationary. We're seeing the same in energy. There weren't fires in the oil fields. It's to cover up for central banking misdeeds, the inflationary, in my personal opinion. Yeah. Can I bring you to the Hong Kong? This was your favorite. Is it still your favorite for almost cancellation failure?
No. It's still our favorite, and we just topped up our position. We're currently adding to the position, and we think it's, again, I think people really have to understand. In my overall portfolio, it's a small position.
Yeah.
But in our asymmetric hedges, it's our biggest position.
Yes.
Right. And so But the asymmetry of this trade is such that if I'm wrong, I lose 1% or 2%. But if I'm right, I make 30%.
So let me
right?
just demonstrate that
the
point, Brent. It's such a good point. I'm going to cut in and just do that. For everybody watching, here, this could be, I'm not suggesting it is, Brent's stop. In terms of his previous, or in terms of previous moves, had you had a stop there, this was your potential gain. This is what he means by asymmetry. A very controllable risk to the downside and an absolutely whopping potential gain to the upside. If I were to just demonstrate on the last...
You think about a currency peg. The reason that they're pegging their currency is it wouldn't stay at that level without the peg.
Correct.
So whenever you're close to the peg, you can put your trade on, put your stop just right below it. And if somehow, for some reason, it's the first currency in history to break the peg because it's too strong, you're stopped out and you lose a tiny bit.
Yeah.
But typically, if you look throughout history, when an emerging market currency peg is broken, it typically moves between 25 and 50%. It typically doesn't move less than 20 or 25%, and sometimes you get a 50 or a 60% move. So just pretend you take somewhere in the middle of there. It's a 30% move in a currency.
Huge.
I mean, that's a big. I mean, it's enormous.
Absolutely.
The amount of leverage you can get putting these trades on, because nobody thinks that's going to break.
Correct.
It's
bankrupting. It's bankrupting trades for the other side, and it's career-making trades for those that put it on. Can correct me or debate this point. All dollar pegs will fail in the process of this reset, almost as a highly probable hypothesis. What's your take?
I totally agree. I've said on several occasions, all currency pegs are going to break.
Because there's the Saudi riyadh.
Exactly. And here's the thing: if I'm even a little bit right, there's no reason for me to make that statement other than I believe it. In other words, there's no upside for me to say I think all currency pegs are going to break. The only upside I have is saying that is that I think it's true. But even if one or two of them break, right? If one or two of them break and you have even a small trade on them, you get these incredible asymmetric returns that these don't come around all the time, right? And I think we are in the perfect storm for this to happen. Now, maybe we'll get through the storm. Maybe the hurricane will pass, and maybe our presidents and our central bankers are fantastic captains, and they'll be able to steer the ship through this nightmare. I'm not betting on them. So,
where do you close?
Yeah.
Or on what basis would you close your Hong Kong trade, assuming it doesn't go to technical zero and you just get closed out with the perfect trade? On what basis? On what ground?
I think if for some reason China just kind of takes over the whole country, which they kind of already have, and they take the new currency and they issue some new currency and the U.S. allows them to do it and doesn't put pressure on them, and the military or the rhetoric between the countries falls, and somehow they're able to get out from underneath the dollar debts that they have, and China's able to deleverage. Maybe, but I think that is so unlikely that I'm willing to bet on it. But
what do you think they do? Do you think they'll just take the Hong Kong dollar at a fixed level and peg it into the CNY and absorb it into the CNY? So all Hong Kong dollars, you have a year, they're going to come into a CNY, they're going to be worth X CNY, and they just phase it out in a space of a year, and your trade.
Yeah, this is pure speculation, but my guess is that it could be part of the rollout of the digital yuan. If they are able to, let's just say they peg instead of pegging the Hong Kong dollar to the dollar, they peg it to the yuan, and then they tell everybody that's going to trade with China, you have to use the digital yuan. And if everybody around the world says, you know what, we think that sounds like a great idea, and we have no problem buying the digital yuan, and they do it in mass, and trade flows continue in, then I'll probably be wrong, right? I don't think that that's going to happen. And the cost of being wrong is so small, I can be wrong for a long time without it being disastrous.
Yeah, I get that. And that's a point well made that many traders should all look. We love highly expansive rewards with tight risk. That's our game. We chase R's, not cars. I say it all the time. And your trade on the Hong Kong dollar is absolutely that one, and a few others that we've mentioned here tonight. just for those listening.
Let me just make one quick point here, because I think, again, I will fully admit, listen, I've been talking about this for 3 years now, 2 or 3 years now, and it hasn't happened. And listen, it might be another 2-3 years before it happens. And so I have a lot of people saying, well, you got the timing right. You can't make any money that way. But how many people have been long gold for 10 years? How many people have been long uranium for 10 years? How many people have been long Bitcoin they were long Bitcoin forever and it never paid off, and then it did, right? The point is, these big macro themes take a long time to play out. Silver, it hasn't played out in 10 years either. But you can find numerous really high return, high risk, high return opportunities that just haven't paid out yet. It doesn't mean that they won't, right? So, the idea that I have people who are in silver or uranium or these others telling me my thesis has taken a long time to play out, I kind of have to chuckle a little bit, because, it takes a long time. And, if you're going to, I think this is important for somebody to understand. If you are going to make contrarian plays, it's going to hurt. You are very rarely going to make a contrarian play and have it play out right away in your favor. And if it does, you're just lucky.
Yeah.
There's this famous scene in Lawrence of Arabia where Lawrence of Arabia puts out this match with his fingers, and then his friend tries to do it. He says, wow, that really hurts. And he said, what's the trick? And he said, the trick is not minding that it hurts. And I kind of feel like that's the case with these big global macro long-term plays. They're going to hurt for a while. If you're going to be in that trade, you have to not mind that it's going to hurt, right? But eventually you're going to get the payoff. And maybe you won't, but every now and then, if you just get one of them, they pay for all the others.
That's it. And you only need one of them. Just on your comment on the USD CNY, dollar strong, but actually it's not doing
versus the yuan has been strengthening versus it.
Yes,
I think they've been getting plenty of capital inflows. People around, as we've had this global melt up. People around the world have been willing to fund projects in China, so they've been sending their money into China. It's going into their sovereign bonds. It's going into their currency, which then gets the dollars come from around the world, and then they get converted to yuan and invested in the country.
It almost felt like me, Brent.
It's
sorry to cut in. It almost felt like this Evergrande was almost trying to create some doubt over China to try slow down. I mean, imagine what the euro CNY chart looks like. If this is what it's doing to the dollar, this down leg, it's almost as if the property bubble scenario, it's a ready-bake news item to unpack at any point that the currency is doing something a little bit too independent and too strong relative, given that it's the workshop of the world.
To me, I think they are keeping it artificially strong as a show of strength in order to encourage more people to send the money in, because that's what they need to keep it going. So to me, it's not necessarily a Potemkin village, but to me it's a bluff, for lack of a better word. I mean, they have so much bad debt in China. If you think the United States has a lot of bad debt, or Europe has a lot of bad debt, Evergrande alone is a $300 billion problem. That's half the size of the TARP bailout from 13 years ago, right? And that's just one company. And if you think about it, their currency is getting stronger. So as their currency gets stronger versus both the euro and the dollar, it makes their exports more expensive.
Yeah.
Right? So they're between a rock and a hard place. I mean, they really are. Now, perhaps they have a way to solve it. I don't think they do.
But does this turn as part of the USD when we start getting we accelerate in the failure, and let's say we start to get euro collapse? Does this turn on the CNY? In other words, this is a fake strength.
Yes.
And they all fall into line, losing ground to the dollar.
Yes, not only that, but eventually China may want to keep the peg, but they may be forced to let it go. And if they are forced to let it go, the reason that they would be forced to let it go is because as the yuan gains strength, they get deflationary pressures inside China. That is bad economically and it's bad socially, and the CCP doesn't like either one of those. So as as if this credit crunch continues, they've already started injecting liquidity. If they need to do more, they eventually may need to let the peg go. If the peg goes, the reason they would let the peg go is because that would allow them to import inflation to counteract the internal deflation. But if they import inflation, then they're sending deflation to the rest of the world. If the CNY peg goes, the dollar's going to go through the roof.
Yeah.
It's just the way it works.
Yeah, which is very much like the Euro Swiss franc, which I think has got an unofficial soft hold at the moment. The franc was initially the first to run against the euro before the dollar, and then it's held at its current lows whilst the dollar has made new grounds. And it's almost like they're going to build the dam wall again. I have a suspicion whether it'll be validated.
Well, that's another good example to use. I don't remember if it was 2014 or 2015, but
January.
Remember the Swiss, the January of 2015, was it?
Yes, January.
Yeah,
it was January.
And so, the Swiss kept saying, we're going to maintain the peg, we're going to maintain the peg, we're going to maintain the peg. And then one morning, Thomas Jordan said, you know what, we're not going to maintain the peg.
Exactly.
It was 25% move, and that, I don't remember what the fund was. There was a fund in Miami that was long, I think long Swiss franc, and just got wiped out. And then 2 or 3 months later, it was back to the same level, and it's been kind of slowly drifting lower since then. But that's the type of, when a currency peg leaves, if that happens to the Swiss franc, look how big that move was. That's the Swiss franc. That's one of the most respected currencies in the world. If that happens to the Swiss franc, imagine what happens to
This is the euro failing against the Swiss franc, so that's a spike in strength.
I'm saying it backwards. But if that happens to the euro, which is one of the biggest currencies in the world, imagine what happens to an emerging market currency when a peg breaks.
Oh, absolutely. Yeah, absolutely.
I apologize. I was saying it backwards. I apologize.
Well, this is what I wanted to try emphasize for those that are watching. The concept that Brent brings conceptually and the macro technicals that we are bringing conceptually is probably bringing to the table in the not too distant future real asymmetric Rainmaker trades. If you're a free view on this YouTube channel right now, you're getting the fundamental narrative from Brent with some real clever thinking on how Triffin dilemma actually works out and how the demand for dollars actually sees first strength and the breaking of everybody else by that strength, seeing everybody run to the last strong man in the room before the eventual death of the entire system. And these are real Rainmaker trades. There's real possibilities with tight stops. Money management can be employed and truly asymmetric rewards can be attained. And that's what we have in common with Brent. And that's what we like. We're chasing the R. So it's true, real value. I want to take you into the modern. How do we do this transition? The central bank digital token. Is China going to be the first? You touched on it. Many of the guys will be asking about this. Is this good or bad for crypto? Because there's some thinking. You hold Bitcoin in your fund. You're not just a dollar trading guy. You hold gold. I want to bring you to precious metals before we let you go as well. We also had gold and silver going up. Maybe let's just do the gold before we go into the modern stuff, the digital tokens and Bitcoin. We've had gold, Brent, because you've had experience as a gold fund manager, and it's something you know very well.
So one of the biggest pushbacks I've gotten over the last 2 or 3 years is that I said we're going to get into a situation where the dollar and gold are rising together, and I've had so many people just tell me that's not possible. But I'm here to tell you it's not only possible, that it's going to happen. Now the gold has had a nice little run here over the last 2 or 3 weeks. I actually was ready for a breakdown, and we got a little bit of a breakdown, but then we had a really nice bounce. So I've been long gold for a long time. I don't necessarily think that everybody should chase it right here. I still think it's possible that we get a pullback before the year's over, or even into the first part of the year. But gold is something that you need to own regardless of the price. And it's not something that I trade on an active basis. I might have a small position where we go long or short just on some tactical trades, but we have a long-term strategic allocation to gold that I think everybody should have. Again, the dollar. If the dollar is the best of the fiats and gold is better than all the fiats, you can get a situation where the dollar is rising versus all other fiats, but gold is rising versus dollar, and then it's rising versus all the other fiats. So you can, and not only that, but when the dollar starts to rise, I always tell people there's nothing more long-term bullish for gold than a rising dollar, because the dollar rising will destroy the monetary system.
Yes.
And if the monetary system starts to crumble, gold is going to put itself forward as a worthy contender for its replacement. And, it always has, and it probably always will. Now, does that mean we're going back to a gold standard? No, not necessarily. I actually don't think we're going to.
No.
But that doesn't mean that gold can't go to it doesn't mean that gold can't go to $3,000, $4,000, $5,000. And I could probably even paint a few scenarios where it goes higher than that. So again, it's kind of insurance. It's one of those things you kind of need to own. You kind of hope it never pays off. Again, I think there's some people out there that we have gold goes to 5,000 and now they're rich and it's a great world and they're flying around in private jets, and it's probably not going to be that way. Gold at 5,000 is not necessarily a world I want to live in, but I think it's probably the world we're going to get anyway.
Yeah, I'm just highlighting this on the chart, bringing it back to the screen there, Brent. Since the last week before November, you've had an up day up week in the Dixie. You had a second up week, you had a third, you've had 4 up weeks. And of part of those, were largely flat the first week, little bit negative, and you've had 2 super strong weeks in gold. And we're roughly at about break even for this week, but I would still see chance for further upside. So actually the bulk of the move, those 2 middle candles, is gold up on a strong dollar.
Yeah. I think so. Now that we have kind of broken out, I think we probably go higher into later this week or next week. I would probably not be chasing it next week. Again, I think if you don't own any gold, then you should just buy some and forget the price. But if you're a trader, I wouldn't necessarily be chasing it at these prices. I think after, this week or next week, we'll probably do to get a pullback. But, I think gold is something that you need to accumulate on weakness.
I'll just throw in super quick the dollar-silver ratio, which for us seems to be looking like it could even be doing a critical reversal. I'll just show this chart too, because it's good. It's good if silver is going to be additionally dominant on precious metals generally, and putting that back on and just dropping it down to a slightly smaller time frame. We've again a lot of reversal structure taking place at the moment. That's a kind of a head and shoulder on the gold and silver ratio. A lot of annotations on here. Maybe I'll just switch them off for a bit. It's a bit intense, but that's a broad head and shoulder with a possible rollover. And that would take us.
I think silver goes even higher than gold, but again, I think the sell-offs in silver are a little hard to take for some people. You kind of have to have a strong stomach for some of the sell-offs. But if you've got a decent time horizon and you're willing to stand a little volatility in a portion of your portfolio, I think silver has a role to play. Yeah.
Absolutely. Central bank digital tokens and the end game, because that's got to be the beginning of the end. There's obviously an overlap period. Is China going to be the first? How do we play out? Talk about the modern world that we're getting, Brent, and what's your take?
I think that, so I do think this global reset of the monetary system, for lack of a better word, is probably coming at some point in the next 2, 3, 4 years. Again, I don't think it's going to be next week. I think it's going to take longer to play out than most people do. But I think as part of that, digital currencies are going to get rolled out. And I think digital currencies are probably part of the reset whenever that comes. It seems like China will probably be the first. There's no guarantees there, but I think it will probably be the first. Interestingly, its rollout so far is the test case. It wasn't really widely adopted. It doesn't mean that it won't be, but but I do think that they're kind of in the lead. But Europe's not far behind. The Fed has come out and said that they're studying it and they're probably going to do it. I think it's going to be really interesting when those come out, because Tether, in my opinion, has just totally permeated the crypto space. It's hard to look at the crypto space and not consider Tether. It's the biggest stable coin there is. It's the biggest money market fund, if you want to consider it that.
On that point, Brent, I could get 9% on staked or put on hold Tether. So this is a key point I'd like to take you up on. It's almost like we have a 2-tier monetary policy world now because of cryptos. In the one hand, you have this highly suppressionist fake non-interest rate. There's just no benefit for saving in dollars in a bank account. You get 0.1%, you get ridiculous. If you borrow on a credit card, you're at 15, 14, 16, 9, 21, depending on your profile. But it's anywhere between 6 and 30%. but you just can't get a yield. And then in this staking world, which is this parallel universe, it's almost like because of how much suppression there is here and how much desire for new adoption, you're being tempted with far, far better. So the monetary policy is reasserting and exists properly where there is a savers, holders, stakers event in the crypto realm. And you should be staking tokens or staking Tether or stable coins and actually getting real yield. Why are people holding dollars in bank accounts where banks can go bust? There's so much additional risk. I'd say the risk, you're not got a zero risk environment on a stable coin, but I would say the risk is very, very, very low in a growing, burgeoning, required new financial system. I wouldn't lose sleep about being in stable coins for lengthy stake period. What's your take on this two-tier monetary policy that's existing? And surely more and more people must wake up and more money should be going out of traditional fiat and banks into the stable token, and obviously the central banks are wetting the bed about stable coins.
Yeah, so this might be an area where we disagree a little bit, and I'll tell you why. I don't necessarily. So there's a lot of things I like about the digital asset world and the yields that you're talking about. Is because it's a free market. People have built it up. People, it's buyer beware. You go out there, and I like that. I love a free market. There's no government or very little government influence. There's very few of the policies that they're, that they need to succumb to or submit to. And so I think some of those yields are offered because it is very high risk, high reward. I think the other part of it is that, it's what the market will bear. And I think a part of it is also there's some scams going on out there.
Let's be specific. A USD Tether, where they've given some disclosure of what assets they hold, far from perfect. But a lot of it is US debt. So if you think US debt's going to fail, then you've got a problem anyway in your bank. And say with a big exchange like Binance, 9.9% or whatever it is, lock it up for 3 months. Would you really say extreme risk, as opposed to?
I don't know extreme risk, but there's just more risk. I don't think that you get 9% with no risk. I just don't. I think I think the yields are what they are because risk does exist. Now, you may think that those risks are appropriate, and you may think that 9% is an appropriate return to get for taking the level of risk. And that, again, that's the market speaking. It's there because that's what the market has chosen, right? And so I have no problem with that at all. Where I think it gets interesting is when these governments start to roll out their own digital currencies. I do not think that they are just going to stand by and allow competing stable coins to exist. Now, that doesn't mean they're going to ban Bitcoin. It doesn't mean they're going to shut them all down. But what I do think regulations will increase. I've seen proposed legislation, hasn't passed yet, that says if and when the U.S. issues a digital dollar, for lack of a better word, then all other U.S. dollar stable coins will need to apply to the U.S. Treasury, and the U.S. Treasury Secretary will alone be able to grant those licenses. Now, whether that passes or not,
if I can jump in for a second, they don't want the dollar to die. The dollar is the least keen about the digitalization of everything because it knows it's probably the beginning of the end game, an alternative currency system. So they may be the last, while China and maybe places like Russia that are antagonized by America or are the antagonists, depending on whatever your political view is, will rush to be first. So surely it's more about time. The original financial, to me, the risk of money in the American banking system is bail-ins and the fact that I'm almost as certain that the legacy system is going to go Bretton Woods. So for me, there's a certainty and you get paid 0.1% for that certainty. Whilst the new system should have a few years run until the dollar is being listed, then there might be some turbulence, take it off. I'm not saying lock it up for 10 years and hope for the best. Maybe Tether gets denied a license because it was the original one and it's resented and it was Bitfinex and so there will be a few scalps taken. But
I think the other interesting point of it, let me just get this in there. I think we've only got a couple more minutes, but what I think is interesting is that to a certain extent, people are saying, why, if the government was going to shut it down, why haven't they done it already?
Yeah.
Well, to a certain extent, it's kind of like this plausible deniability, or they don't mind letting it go on because in many ways, Tether and these other US dollar stablecoins, which are by far the US dollar stablecoins are by far the biggest stablecoins in the entire ecosystem. It reinforces the dollar as the global reserve currency. It's almost like euro dollars. Euro dollar demand reinforces the dollar as the global reserve currency.
Yes.
So as long as they're not directly competing with the US dollar, and as long as they're not prohibiting the US dollar and the Treasury from doing their operations efficiently and correctly and they really probably don't mind it being there because it solidifies their position. But if that ever starts to change, I don't think that they're just going to sit by and if it were to literally start threatening their own existence, they may lose. The U.S. government may lose, but they will not go down without a fight. That's my only thing. That's why I say buyer beware. I have no problem with having an allocation to digital assets. I find it a fascinating arena. I love free markets, but I just don't think it's an automatic win that you just get to put your money there and there's no risk being involved.
Do you say or concede or accept or have a notion that once many central banks of major economic zones have released their version of a central bank digital token, does it automatically mean the beginning of the end of dollar hegemony, or not necessarily? Because as long as oil is priced in dollars, these things can coexist for a while, and it can more peter out in a much more slower way. So we could have.
I don't think it spells the end of dollar hegemony at all. In many ways, again, you have to realize the U.S. does not want the dollar to go to 130 or 140, right? So they need to find outlets to keep the dollar under control and they don't want the whole world to collapse either. They want to stay as the global hegemon, but they'd love to keep it going. So if there's a way for Asia and Europe and Africa and South America to more efficiently and quickly and easily, distribute currencies to their citizens, and they're able to keep global, currency rates somewhat stable, if digital assets allows them to help them do that, I don't think that's necessarily a bad thing, or that they would necessarily, automatically, get rid of it.
Got you. Brent, it's been fascinating. Thank you for your time. We've had a great chat, and there's so much more I feel I could chat in, but we've got to respect your time and keep it an hour and a half. There's so many questions that gone unanswered. If people wanted to engage with you, how is the best way to do so?
So I always tell people I'm happy to answer questions to the extent I have time to do so. You can send me an email. It's brent@santiagocapital.com. If you go to santiagocapital.com, it has my address and my contact information there. I'm pretty active on Twitter. You can either type in Santiago Capital, or the handle is Santiago AU Fund. Either way, but you can find me there. I do a number of these different podcasts and interviews. If you go to YouTube or Google and you type in Brent Johnson Santiago Capital, you'll get a number of different links that you can watch. And I always appreciate you inviting me on. I'm happy to come back. We could probably talk for hours and hours. So I know if you want to do it again in another month or so, I'm happy to do it.
That would be great, and we may take you up maybe a year end. Your 3 best trades or investment positions, as in parting shot. Where would someone who's starting from naught, has $100,000 in his bank account, realizes he's ill positioned, wants to carve it up, maybe 5 ways, 3 ways, where would you have him?
You know what? I think there's great uncertainty right now, so that's what I would do. It sounds very simple. Many people will laugh, but I put 25% in cash, 25% in equities, 25% in real estate, and 25% in gold.
Yeah, that sounds good, and it's simple and it's clear to understand. And when you say equities, you're talking about American, and you're talking the exponential growth stocks, which could be NASDAQ or agris or
the Dow, just the Dow or NASDAQ, maybe a combination of the two.
Yeah. Brilliant. That's nice and clear. Thank you, Brent Johnson, for coming on and sharing your great insights. It's been an absolute pleasure, and I've enjoyed it immensely, and the time has absolutely flown. To all you guys that checked in on the live stream, check out Brent Johnson. He's followable on Santiago AU Fund, at Santiago AU Fund. Check out his sites and potential investment opportunities as well. Thank you very much. Give us a final share as you check out. Brent, thank you, and we'll catch you again soon. All the best to you, and enjoy sunny Puerto Rico.
All right. All the best.
Bye-bye.